This conversation is powered by Google Illuminate. Check out illuminate.google.com for more. Welcome to this discussion on the Federal Reserve's regulations concerning foreign branches of national banking associations. It's a complex area, but crucial for understanding international finance. We'll be exploring the intricacies of Section 25 of the Federal Reserve Act.
Indeed. Section 25 lays out the framework for U.S. banks' involvement in international markets, outlining the permissions and restrictions they face. It's a fascinating blend of enabling growth and mitigating risk.
Exactly. The capital requirements alone are significant. What's the minimum a bank needs to even consider operating a foreign branch?
A minimum of $1 million in capital and surplus is required to even apply for permission. This ensures financial stability and reduces the risk of failure impacting the U.S. financial system.
$1 million is a substantial barrier to entry. What other hurdles do banks face?
Beyond the initial capital requirement, the Federal Reserve Board holds significant power in approving or rejecting applications. They can impose conditions and regulations to ensure responsible operation.
So it's not just about having the money, it's about demonstrating responsible financial management to the Fed.
Precisely. The Fed scrutinizes applications carefully, considering the applicant's financial health, proposed operations, and the potential impact on the U.S. economy.
Let's delve into the specific powers granted under Section 25. What are the key permissions given to banks meeting the capital requirements?
The Act allows banks to establish branches abroad to support U.S. foreign commerce, act as fiscal agents for the U.S. government, and invest in other international or foreign banks.
So it's a multifaceted permission, not just about opening a branch in another country.
Absolutely. It's about facilitating international trade and finance, acting as a conduit for U.S. government operations overseas, and participating in the global banking network.
The Act also places limits on investments, doesn't it? What are those restrictions?
Yes, there are restrictions. For example, a bank can invest up to 10% of its capital and surplus in the stock of other banks or corporations primarily engaged in international banking. There are also stipulations about the activities of those foreign banks.
So it's not an open-ended investment policy. The Fed maintains oversight to prevent excessive risk-taking?
Exactly. The Fed's oversight is crucial. They ensure that investments are aligned with the purpose of supporting U.S. foreign commerce and don't pose undue risks to the stability of the U.S. banking system.
The application process itself seems quite involved. What does a bank need to include in its application?
The application must detail the bank's name, capital, the powers sought, and the locations where operations will be conducted. The Fed has the authority to approve or reject the application in whole or in part.
And the Fed's oversight doesn't end with approval, does it?
No, it continues. The Fed can conduct examinations of foreign branches and affiliated banks to ensure compliance with regulations. They can also adjust the number of locations where a bank can operate.
What happens if a bank or its foreign affiliates fail to comply with the regulations?
The Fed has the power to investigate non-compliance, subpoena witnesses, and even require banks to divest from non-compliant entities. This ensures accountability and maintains the integrity of the system.
So there are significant consequences for non-compliance. This underscores the seriousness with which the Fed views these regulations.
Absolutely. The regulations are designed to balance the benefits of international banking with the need to protect the U.S. financial system.
Section 25 also allows for additional banking powers to be granted under certain conditions. What are those?
The Fed can authorize foreign branches to exercise powers common in the locations where they operate, but with restrictions. They cannot engage in general merchandise trading or securities underwriting except under very specific circumstances.
This highlights the careful balance the Fed seeks to maintain between allowing flexibility and preventing excessive risk.
Precisely. The goal is to facilitate legitimate international banking activities while preventing activities that could destabilize the U.S. financial system.
The Act also mandates independent accounting for foreign branches. Why is this important?
Independent accounting for each branch ensures transparency and allows for accurate assessment of profitability and risk. It also simplifies regulatory oversight.
This separation of accounts provides a clearer picture of the financial health of each branch and the overall international operations of the bank.
Exactly. It's a crucial element of risk management and regulatory compliance.
The document mentions a provision that's now obsolete. What was that?
There was a temporary revision allowing banks to invest in corporations engaged in international financial operations to facilitate exports, but this expired on January 1st, 1921.
So the regulations have evolved over time to reflect changing economic conditions and risks.
Absolutely. The Federal Reserve continuously adapts its regulations to address emerging challenges in the global financial landscape.
Looking at the overall impact of Section 25, what is its significance in the context of U.S. international finance?
Section 25 is fundamental to the participation of U.S. banks in the global financial system. It provides a framework for responsible expansion while safeguarding the domestic financial system.
It's a delicate balance between fostering growth and mitigating risk.
Precisely. The regulations are designed to enable U.S. banks to compete internationally while minimizing the potential for negative consequences.
Given the ever-evolving nature of the global financial landscape, what future considerations might be relevant to Section 25?
The increasing complexity of international finance, technological advancements, and geopolitical shifts will likely necessitate ongoing review and potential adjustments to the regulations.
So we can expect continued evolution of these regulations to keep pace with the changing global financial environment.
Absolutely. The Federal Reserve's commitment to maintaining a stable and secure financial system will drive future adjustments to Section 25.
The regulations under Section 25 are clearly designed to balance the promotion of U.S. international commerce with the need to maintain the stability of the U.S. financial system.
Precisely. It's a dynamic interplay between enabling growth and mitigating risk, requiring continuous monitoring and adaptation.
The stringent capital requirements, the Fed's oversight, and the enforcement mechanisms all contribute to a robust regulatory framework.
The framework ensures that U.S. banks can participate in the global financial system responsibly and sustainably.
The independent accounting requirements for foreign branches further enhance transparency and accountability.
This transparency is crucial for effective risk management and regulatory oversight.
That was a great discussion. Thank you for your insights.